Hi everyone, welcome to my channel. I'm Doris and I'm here to share with you about my stock account and the market update. Today my account lost 4,250 USD. US stocks closed up more than 2%. The market focused on the Fed policy outlook. The euro hit a 9-month high against the dollar, backs the hawkish tone from the European Central Bank. So let's first take a look at my account. Right now, the net asset of my account is $79,563.89. Today, I lost, including the aftermarket, I have lost 4.71%, which is $3,931.55. In total, I've lost $21,617.57 US dollars. Today, the SQQ decreased for 2.95 or 6.59% to 41.84. The RV decreased for $0.293 or 0.66% to 44.06%. Today the market rose generally, with Dow Jones Industrial Average rose 0.76%, Nasdaq rose 2.01%, and S&P 500 rose by 1.19%. Nasdaq rose particularly high due to its more percentage of tech stocks. Today, the semiconductor stocks rose for 5.17%, and the auto industry rose for 4.63%, which are the biggest gain across the industry heat map, with consumer electronics, software, and entertainment rose more than 2%. US stocks closed higher Monday, led by technology stocks, with the Nasdaq up for more than 2%. Investors are assessing the possibility of the shift in the Fed policy and are waiting for a flood of earnings and economic data this week. US stocks closed higher on Friday, but the Dow and S&P 500 both fell for the week, with Nasdaq posted its third straight week of gains. As of Friday's close, all three major US stocks indexes have maintained gains, with the Nasdaq 6.44%. Michael Wilson, a prominent US stock seller and chief strategist at Morgan Stanley, warned that optimism is too early and US stocks are still in a bear market. In just a week, he said, market views of the global economy has changed, but that has not affected the decline in 2023, and the earnings outlook for companies remain grim. Investors have been assessing whether the Fed is ready to slow its pace of interest rate hikes aimed at fighting high inflation after economic data released last week showed a decline in both wholesale prices and retail sales. On Friday, Fed Governor Christopher Waller endorsed a 0.25 percentage point rate increase at the next meeting. Meanwhile, a prominent financial media outlet on Sunday raised the possibility that the Fed would suspend raising rates in the next spring, saying the Fed activities could come to an end. Deutsche Bank strategist Henry Allen wrote in a note to clients on Monday, as investors become more confident in inflation, it is clear that they are not looking beyond the current rate hike cycle and expect the Fed will eventually pause raising rates and may even cut rates. But investors are now optimistic about inflation. The risk is that inflation does prove more durable, that we could see another bear market rally as we saw last summer. The market now has a nearly 100% chance of a 25 basis point rate hike and raising its benchmark rate range to 4.5% to 4.75%, according to Chicago Mercantile Exchange. The Fed will hold its monetary policy meeting from January 31st to February 1st. Before that, there was no speech scheduled for Fed officials. Investors will be looking at a new batch of economic data, including Thursday's GDP report and the Fed's favorite inflation data, the Personal Consumer Spending Price Index, set to release on Friday. The dollar fell on Monday to its lowest level since April. Analysts said expectations of a slower Fed rate hike has put downward pressure on the dollar. In recent public speeches and interviews, Fed officials said slowing rates rise a more traditional 25 basis point would allow them more time to assess the impact of the rise so they could decide where to stop. The Fed mouthpiece, Nick Timiraos, said the Fed officials are now preparing for a second consecutive meeting and a debate and rates. In addition to a large amount of economic data to be released this week, about 40% of Dow Jones companies will release their latest results this week. Investors will explore how to respond to the inflation and rate hike environment. Key companies reporting earnings this week include Microsoft, IBM, Tesla, Visa, and MasterCard. The euro hit a 9-month high against the dollar, backed by the hawkish tone from the European Central Bank. On Monday in New York, the overall global currency volatility was limited, with the euro falling from a 9-month high, but the currency overall maintained a strong upward momentum. The pair remained strong on comments of further big rate hikes in Europe and less aggressive pricing of the Fed. The euro hit as high as $1.0926, breaking its recent high of $1.0875 and trading at its highest level since April. The European Central Bank looks to continue to raise rates quite aggressively. Aggressive monetary policy was supported by the member of the European Central Bank Governing Council, Klaus Knot and Peter Kitzimer, who advocated another 50 basis point increase at their February and March meetings. The analyst will also supported a 50 basis point rate hike at the next two meetings, eventually rising to a peak of 3.25% from the current 2% mark. Ripple Bank, Jane Foley, head of monetary strategy, said it was also a strong support for the euro as a recession fears eased from falling gas prices. More confidence in the economic outlook, or at least removed much of the pessimism. By contrast, futures markets have ruled out virtually any chance for the Fed would rise 50 basis points next month and steadily reduce possible peaks of rates to 4.75% to 4.5% from the current 4.25%. Investors also expect a rate cut by about 50 basis points in the second half, reflecting weak inflation, consumer spending, and housing data. The January Economic Activity Survey, expected to be released this week, shows that the euro is improving better than the US in the facing of falling energy costs. If the recent PMI survey is credible, the US has lost its global growth leadership, said Ray Achiro, the head of currency strategy at NAB. Moreover, US inflation is expected to fall further and faster to the Fed's own forecast. In that case, the dollar has room to fall further this year. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.